Good afternoon, and welcome to this next episode of Governance Dialogues. It's a pleasure to have you join this program again. For those of you who've subscribed to the channel or are joining us again, welcome back. And for those of you who are new to the program, welcome. And we'll be exploring today a somewhat interesting question that we haven't yet delved into this program in the past episodes. And the question that I've proposed for this episode is, what is beta activism? And to answer that somewhat enigmatic question, I've invited Jon Lukomnik, who's joining us today from the United States, to speak about a book he's co-authored with Jim Hawley, which has been published just a few weeks ago, as far as I understand, fresh off the press, really, and that aims to answer that specific question. So, Jon, welcome to this program. It's a pleasure to have you.
Thanks so much, Alissa. Thanks for inviting me.
Thank you. And perhaps before we sort of delve into the nuts and bolts of the book and the thesis that you put forward in this book, which is rather interesting, I would like to maybe say a few words about your background and your impressive work, both advising institutional investors and also being involved in a number of academic and other roles and associations and whatnot, and also then to say a few words about the book itself. So the book, I think that even the title is quite telling. It's called "Moving Beyond a Modern Portfolio Theory: Investing That Matters." And it obviously draws on your extensive experience, having been at the helm of a number of institutional investors. And I think the numbers speak for themselves. You've been an investment advisor, trustee for investors with more than $100 billion of assets under management, including for some of New York City pension funds, where you had sort of more direct roles. And you've consulted institutional investors with assets under management in the order of $1 trillion. So obviously, I imagine that the book draws on all of these various experiences, as well as your current role as a managing partner at Sinclair Capital, and your various advisory roles at the Public Company Accounting Oversight Board, Deloitte, National Association of Corporate Directors, and many other organizations that you've been involved with. And of course, it's interesting that the book is getting quite a bit of press. And I saw, I think even today, there was an article by Robert Eccles, who I've incidentally interviewed on this program, in Forbes, talking about the book. So we'll come back to that in a minute. But perhaps just in the interest of time, I'd like to sort of delve right into kind of the meat of the book and the thesis that you put forward, which is the inadequacy of the modern portfolio theory to deal with some of the more systematic market risks, and its only sort of ability to deal with more idiosyncratic company specific risks and sort of the problems you see with that. So could you tell us a little bit more about the thesis of this book and this third stage of corporate governance that you refer to we're entering?
So you gave a great introduction. Let me expand on it a little bit. MBT is brilliant. It provides the math for diversification, and that is really powerful. Diversification really is the only free lunch in investing. The problem is that systematic risk, non-diversifiable risk, actually drives much more of your return than does security selection, and therefore idiosyncratic risk that diversification works on. In times of crisis, all correlations go to one. We saw that in the global financial crisis. We saw that at the start of the pandemic. And it's bilateral. We saw it with everything moving up, coming out of the pandemic. And so diversification really provides no tool to deal with systematic risk. The problem is systematic risk actually affects 75 to 94% of your return, which means that MPT provides a great tool for a minority of the impact of what affects your return. And it provides no tool to deal with the causes of systematic risk because it only sums to volatility, which doesn't deal with the causes. And if it's systematic, you can't diversify it. And so what we have said is this stage 3 corporate governance activity, beta activism, which we'll get to, is actually a series of sequential manifestations by investors to try to deal with the things that cause systematic risk.
And it's interesting because in the book you talk about a number of different systemic risks, and obviously we're in the midst of one such risk, and it's difficult probably to avoid that elephant in the room. We'll come to that in a second. But also you talk about climate risks, you talk about diversity related risks. In your work and in your view, what are some of the risks that you believe our investors are least accounting for today? What are some of the blind spots?
Are least accounting for it. That's interesting. I think investors are accounting for it, but they may not have great tools to account for income inequality in the United States, racial justice issues, things which cause social unrest and therefore can cause, if the systematic risk to the social system spills over to the capital markets, it creates systematic risk in the capital markets. The pandemic, the elephant in the room, is a great example. In fact, the pandemic was a knowable and preventable surprise. In the book, we cite the study that 15 years ago said we are going to get a coronavirus pandemic. It is going to come out of the wet markets in China, right? We just didn't do anything. I think investors actually are getting smarter. And so Nordea Bank, for instance, is trying to deal with antimicrobial resistance, which the UK government says antimicrobial resistance, I'm sorry, I should define that. It's the growth of bacteria that are resistant to current antibiotic treatments. And Nordea Bank has been dealing with it by trying to stop the antibiotic manufacturing plants in India from discharging groundwater where these superbugs can grow. Similarly, in the United States, a group called the Shareholder Commons has gotten Yum Brands, which is the parent to KFC, Pizza Hut, and Taco Bell, to do a study of use of antibiotics in the animal husbandry chain to try and deal with it that way. And so I do think people are starting to try to focus on what my friend Raj Thermothoran calls preventable surprises, or what Michelle Wooker calls, gray rhinos.
Yes, no, both of those are great terms, and I've met some of the individuals you referred to, and it's interesting. I mean, I think in the context of COVID, I mean, some of the conversations I've been also listening into with different professional associations talk about the fact that obviously, well, for most of us, it came out of the blue. I mean, you mentioned the study that did talk about it, and as you say, nothing was done. But for most, even sort of in the risk management profession, it's sort of there were no mechanisms inside large corporations to deal with such preventable surprises, you say. But they've had, and some point out that they've had other mechanisms that, for example, allowed teleworking for other reasons, and so companies were able to essentially introduce risk management mechanisms that were actually designed to perhaps mitigate other risks to sort of deal with the COVID risk. So it's interesting how these preventable surprises are being dealt with, these days.
Yes, but it also works the other way, because the question becomes, what's the trade-off between efficiency and resiliency? So for instance, there's a worldwide computer chip shortage. A number of car manufacturing plants in the United States had to shut down for lack of a $2 computer chip manufactured in China, because they wanted lean manufacturing and just-in-time shipping. And now they're sitting there going, wait, so to save the carrying costs on a bunch of $2 chips sitting in inventory, we had to shut down a bunch of $40,000 car manufacturing lines. And so people are now starting to rethink what their business models are around the sort of twin poles of agility and resiliency.
Absolutely, and I think I've also had conversations with, for example, representatives in the car industry. So you speak about chips. I mean, some parts were, for example, I was speaking to somebody who's at Renault, and they were talking about some of the parts that were missing, and what the company was doing to actually integrate better, let's say, smaller suppliers into their supply chain, and how they are dealing with insolvency issues. And and bringing in, almost insourcing a lot of skills that large companies were previously were quite comfortable outsourcing. And I think the other interesting element in that, and correct me if you see it differently, is there's also kind of the stepping in of governments in many countries. I mean, I don't think it's perhaps the case in the US, but definitely in many emerging markets where I work, governments are stepping in and basically saying, okay, we actually see some weaknesses in specific industries like healthcare, food industries, and we would like to, actually play a role in ensuring sustainability. And it sort of becomes more of a story of private public sector tango in mitigating those kind of, let's say, sustainability risks from a point of view of availability of components, medications, et cetera, et cetera.
Right, bringing it back to the book, let me add a third layer to that. Everyone thinks, we never defined beta activism. Beta activism is when investors try to deal with real world systemic risks to the environmental, social, or financial systems before they can metastasize in the capital markets. But what's interesting is we tend to think about things at either a regulatory, which is a national everything level, right? We want to disclose this type of greenhouse gas emission, or you have to have these health and safety regulations, or at an individual company level, right? Activism at a company level for financial purposes. This is activism across the market or a broad swath of the market. Or what's really interesting, since you mentioned these examples in EM, there's a lot of work being done at the industry level. And that is because the same systemic risks affect every company in the industry, which makes perfect sense, but it's not trying to pick the stock of the one that's going to do better. It's trying to elevate all of them so that we can improve the overall risk return of the marketplace. And so, for instance, when there was a mining collapse in Brazil, and the investors involved there, which were AP funded, and the Church of England commissioners in charge of their endowment, looked at it. What they found were mining collapses, tailing dam collapses, which is what this was, happened pretty frequently, about once every 2 months. We just didn't hear about it because they didn't kill 260 people, they killed 4 people. They were in emerging markets, they were developing nations, often where indigenous people were. But they had real effect across the industry. And they formed a coalition with the industry, with the UN Compact, with PRI. And together they created guardrails in effect that lifted up minimum standards for tailing dams. Now, that's something government could have done. But in fact, it was investors working across an industry to try to use this type of beta activism to private sector standard set so as to decrease risk to that industry.
It's a very interesting example, actually, and it sort of makes me wonder, I'm sort of bouncing off a book which has nothing to do with investment. Well, I think for most part, there's nothing to do with investment. It's, I think, by Malcolm Gladwell, who talks about this tipping point, and I'm sure you've heard about it. And I wonder if in thinking about this kind of systemic risks and industry-specific risks, that in your work, you see this kind of tipping point where, investors or companies operating in these sectors all of a sudden sit down and say, wait a minute, we have, a situation in our hands. Is there other examples that you could think of or share with us in terms of this kind of tipping point where investors sit down and say, well, now we actually have this broader systemic risk. It's not just me and you and company X or investor Y.
Sure. The two consensus issues, if you will, are climate change. And clearly the investment community has been involved with that, since before Paris. But the interesting one right now is gender diversity, and diversity generally, but gender diversity specifically. Starting around 27, there have been advocates for gender diversity at boards of directors and generally for decades, right? The 30% Coalition was formed at least 15 years ago. But 2017, we've all seen the picture of Fearless Girl on Wall Street. That was put there by State Street. And it was put there to publicize their efforts on gender diversity. Legal in General has a big program, Fidelity does, BlackRock does, State Street, all the big ones do. And State Street, as part of this, wrote to more than 1,500 companies globally that had no women on their boards. And within 3 years, more than half had put women on their boards. There's now other things were going on at the same time. There was the Me Too movement. There's a law in California about required gender diversity. But there's a recent academic paper out that says that the efforts of investors between 2017 and 2019, over a 3-year period, resulted in 2.5 times as many women being appointed to boards in 2019 as in 2017. And they tried to correct for all these other things. And so investors have gotten together and driven change. They've just said, enough already. Why are we not using the skill set of 51% of the world's population? That seems really stupid. Let's fix it. And we can all argue that the pace of change isn't great enough. It's not fast enough. It's not deep enough. But directionally, it's heading in the right way. And that's at least partially due to investors thinking about these as not just systemic risk, but in this case, also a systemic opportunity.
Yes, of course. And there, as you point out, the diversity one, I think that the Black Lives Matter movement will be another area where we will see change, which is not really, perhaps that was also, well, unfortunately, with the event that we saw with George Floyd's death, possibly has been also some sort of a tipping point where we will see.
BlackRock just agreed to do a racial diversity audit of itself. So, again, we can all criticize many of the large asset management firms for lots of things, not moving fast enough, not being responsive, fee structures, whatever. But around these issues, I think directionally, at least, they are moving in the right direction.
Now, true, and interesting observations, and of course, the BlackRock case was quite widely covered in the financial press. So I wonder. So these are sort of the large investors. We're talking about, the big guys. And when we think about maybe Norges or GPIF in Japan or others, these are definitely long-term investors that are sufficiently diversified that they are kind of, I would say, compelled, maybe is the right word, to look at market risk. Do you think that is also the case with sort of smaller institutional investors or those that are positioned in emerging markets? Or is your research showing differences in approaches, let's say from the European continent to the US to Asia, Middle East, Latin America?
There are clearly regional differences. I think Europe is further along in dealing with these issues for regulatory matter. That's common wisdom. But the underlying structural issues that have created this apply for large and small and in smaller markets. We tend to think about investors, and people say, well, what is a retail investor? We'll go as small as you can get. And they think about some person sitting and poring over financial statements and picking stock A. That's not what retail investors do. They buy diversified indices. They buy the FTSE, they buy the S&P, they buy a mutual fund, a collective trust, an ETF, a UCITS, or whatever. And by definition, they are diversified. And so the market risk affects them much more than, yes, if they only had a single asset, if in theory, the only thing that someone owned was, a manufacturing plant far away where they can externalize all costs and everything, that gives you a different set of incentives. But that's not how people invest anymore. They invest in prepackaged, diversified products. In terms of emerging markets, country risk is a systemic and systematic to the market's risk. So one of my favorite examples is, I'm going to get the year wrong, but I think it was, the Philippines at one point created a series of laws that would have disadvantaged cross-border investors, international investors into the Philippines. CalPERS, a large fund, went public. And they basically said, we're going to divest from the Philippines. Your laws are not fair. And the day they made that announcement, the Manila Stock Exchange went down 3.5%. Now, I will tell you that Manila to Sacramento, California, is not a normal shuttle flight.
No.
But it was for Philippine officials for a while. And within months, they had reversed their announcements. CalPERS announced that they were going to reinvest. The market went back up. And so, again, CalPERS wasn't picking a particular Philippine stock. They were saying, this is an issue of country risk. We can, through publicity, engaging with policymakers, analysis, pointing out why it's unfair, change that. And that's what they did. And so CalPERS was a very early example of using this type of data activism in an emerging market.
Yes, absolutely. And I think that there's also an interesting conversation, and we've been delving in that in this program in China, and what institutional investors are doing in sort of the Chinese market. And because it is, let's face it, much larger than the Philippines market, and very much interesting, but also subject to a lot of political dimensions, as you surely follow, with the different laws that were passed by the Trump administration to restrict dual issuers, and to also render the accounting, the books of Chinese auditors of Chinese companies more transparent. So there are also interesting dynamics between sort of regulatory pressure and investor pressure on specific markets, right?
Absolutely. And I don't want to pretend that what we are suggesting is a solution to all market problems. It's not, right? I mean, I'm a practitioner. I dabble in academia every once in a while. So I don't want to overstate it. What we are suggesting is this set of third stage tools, this private sector standard setting and engaging with policy, things which extend investing back into the real world beyond the trading terminal and a bunch of electronic dots, are tools in the investor toolkit that can mitigate some risks, but it doesn't mean they mitigate all risks. It has thus far been impossible to gain adequate assurance around Chinese firm audits. And that is an issue, particularly for people investing in Chinese firms which are only listed in China. Secondly, there is, as you said, occasional political interference. There is in every country, right? I mean, the US has something called CFIUS, and I remember when France refused to take over a bid for Danone because all of a sudden yogurt was a national security issue. So, there are national champions. It used to be the airlines, clearly defense industries everywhere, where there are political risks. The issue with China is A, China is the second largest economy in the world. B, it's not always clear what the rules are. And that's why people get a little nervous about Chinese investing. And the tools that we have outlined work best when there is transparency and when you can operate within a defined set of governmental rules. So I don't want to overstate the effectiveness of the tool set, but it does extend effectiveness to systematic risk, certainly in developed markets. It doesn't obviate it. Clearly, we still face China climate change issues. We still face scientific issues. We still face discrimination issues. But at least we now have a tool set that can be brought to bear on it.
Yes. And it's interesting. I think, philosophically speaking, I think it's also interesting to think about that debate, because we're from where I sit, I see a lot of responsibility almost being shifted to the hands of investors. And I would say, maybe if you look at it from a historical perspective, we're kind of seeing quite a bit of responsibility being shifted that you could argue used to be in the realm of governments to some extent through more direct regulatory policy, and now it's shifted to the hands of large institutional investors to say, you oversee social risks, you oversee climate risks, you oversee governance risks, and you mentioned in your just in your comments just a second ago your tools around addressing this sort of beta risk. Do you want to say a few words, a little bit more about the details?
Sure. I mean, first off, I think there's a reason why you're seeing more things shift. I mean, the largest companies in the world have as much impact on your day-to-day life as does government, and in effect become private sector standard setters, as do investors, which I'll get to in a second. That's one of the major tools. But if you think about the fact that Twitter and Facebook have taken the former president of the United States off of their platforms, and that he's upset about it, think about how much power those companies have, or Google or Amazon or national banks. The fact is that big business have economies as large as the largest countries, and they affect people's lives. And so they need accountability. And the accountability mechanism we have in a capitalist society is the people who have the capital, which are the investors. There are certain governance rights with it. So what tools get used? There are tools that reintegrate investing with the real world, private sector standard setting. So governments were unable to come to a conclusion about what should we be disclosing on climate. When BlackRock says, please disclose according to TCFD and SASB, all of a sudden TCFD and SASB become more powerful. They're tools around additionality. When when investors think, what is this investment going to do to the environmental, social, and financial systems of the real world? There's a reason why clean tech funds exist, right? It's because the investors are looking for what is there besides the risk return of the investment. What are the externalities that can create some positive externalities from these investments? Tools around polity. You have investors engaging governments around climate risk, around antimicrobial resistance in India, around all sorts of things. What is interesting to me is that the investors have to choose what topics they're going to look at. And they often tend to choose things that align with their investment philosophy. So if you're a massive global investor, you tend to think about things like climate change, which affect everyone. But I have to tell you, some tech investors are looking at things like the governance of technology, the misuse of artificial intelligence. Some of the Northern European investors are looking at things like fair taxation. Why can someone place their intellectual property in a tax haven, charge themselves a fee, and pay no taxes in the United States or the UK or Denmark? And so the idea that investors are looking out for the health of the systems for self-interested reasons is new. And what we are suggesting is that people tend to think of these as political. And there's a reason for that. If you're going to be a large enough risk to affect the capital markets, you have to be large, and you're probably been written about. So gender diversity, climate change, racial justice issues, income inequality, get written about and talked about, and people say, oh, you're just being political. No, you may be political, but you may also be trying to reduce the eventual systematic risk of the marketplace.
I think a number of really interesting points. I mean, I think that the political aspect, I mean, not really many admit to it, but it is inherently, political, whether you're, arguing or moving in certain directions, like diversity that can be political. I mean, there's now consensus around many of these subjects, but not necessarily among some of the more niche issues that you're talking about, where you, as you were pointing out, there is a level of investor differentiation. And I'm happy to hear about that, because in my view, a lot of there's a little bit of a limitation in the sense of all the large institutional investors sort of playing from the same playbook. But then, there are questions as to whether they're then whether there are investors looking at sort of more specific issues.
There are. I mean, we counted, when we first were going to write the book 5 years ago, we were going to enunciate all the beta activism campaigns. And 5 years makes a huge difference. We soon realized there were more than 100 of them, and we couldn't possibly do it. They change. I mean, there are people looking at deforestation, biodiversity. What's interesting is if you think about these as what are the material risks? Things become material, yes, when ethics and values move. Slavery was a major part of the capitalist system in the 1820s, right? Modern slavery exists, but it's pretty well roundly condemned. And in fact, there are investor coalitions fighting it. But the other place that it moves is around our understanding of science. Climate change is not an obvious answer of that. I like using the antimicrobial resistance example because fewer people have heard of it, and they're being successful in it. But artificial intelligence, which everyone was hailing wonderfully, all of a sudden we realized that it recognizes men's faces better than women's. It recognizes white people's faces better than dark-skinned people's faces. It's one of the voice recognition. One of the insurance companies in the UK got fined and had to exit a line of business because the voice recognition that they were using on artificial intelligence turned out to be biased, and the UK regulators came down on them. And so it's not that anyone wants to cut off innovation. It's that we want the governance of the innovation to be equally robust to the innovation.
No, absolutely. And this is a topic, particularly in the context of tech governance, that I've been covering quite a bit, also with the looking at big tech, because obviously that's an elephant in the room with the Department of Justice investigations, and also the actions here on the side of the European Commission looking at governance of big tech. And I think, in my humble opinion, it's going to be an area where we'll be seeing quite a bit of action this year, and I think also probably next year. But in the interest of time, I know that our half an hour is about to be over. I'd like to thank you for the insights and for sharing some of the big highlights from your book. We'll obviously put a note and a link to the publication and some of the media coverage the book has been receiving. Just before we close, I don't know, perhaps I thought that you would like to say a few words, in a sort of elevator pitch as to kind of some of the new directions that you see that perhaps, we spoke about some of the areas that the climate change, where there's been quite a bit of action already, but some of the areas that, maybe we haven't yet really been focusing on, where you think institutional investors or kind of beta risks, institutional investors will be looking at new types of beta risks.
Well, I think we've mentioned some of the technology, certainly in artificial intelligence, but technology overall. Income inequality is, I think, the one I hear about the most, because there is a concern that income inequality threatens democracy and markets, that it sets a foundation for autocracy. And we have not, I think, yet figured out how to deal with that. There are bits and pieces, but I've heard people talk about combating income inequality through everything from pay ratio disclosures and executive compensation to labor organizing rights, to dividend policy, comparing what shareholders get to what workers get. And I don't think there is a consensus on how to do that yet. But if I were going to if you are forcing me to say what will be a consensus issue over the next 20 years, a la climate change or gender diversity, I would say it's income inequality. Now, there is one major difference, and I think we have to acknowledge it. Climate change, there is a science to it. You can say, if you do this, it's 1.5 degrees. If you do this, it's 2 degrees. Gender diversity, you can measure pretty easily. We may all think that income inequality is a problem, and I do, but I cannot say with confidence that the Gini coefficient should be this versus that. And so there will be debate and overlapping and divergent interest, and that's okay, because what you wind up within is a marketplace of ideas around this.
No, thank you very much, Jon. I think it's very interesting, and actually, one of the episodes we released on this program about 3 weeks ago was exactly on topic with a conversation with Tom Gosling, whom you possibly know from the London Business School, who is an expert in executive compensation, and where we talked about these ratios and some of the problems. Despite their popular appeal of sort of comparing the CEO to average or median worker pay, some of the issues that arise with using these metrics. But it's
every once in a while you just have to use common sense. And if you're paying someone more than a small country's GDP, it's probably too much.
That's a fair point. We'll probably stop with that. But I will, as I said, we'll be sharing a link to your book, and hopefully our audience will be tapping in some of the resources some of the research that you've been doing, and the articles that the book has generated since its release. So congratulations. Once again, it was a pleasure to host you on the program, and we hope to have future conversations on this topic, maybe in a year's time, to take the temperature of where we stand.
Certainly. Thank you again. Thanks so much for inviting me.